Stop everything you're doing right now because silver just broke one of the most fundamental rules that Wall Street has believed for decades. 3 Federal Reserve presidents came out with hawkish comments. Rate cut expectations got pushed back from June to July. The entire financial media narrative shifted to rates staying higher for longer. And what did silver do? It rallied. It pushed back above $90 per ounce. It touched a 3-week high while completely ignoring what should have been bearish news. This is not supposed to happen according to the textbooks. When the Fed signals it's not cutting rates, precious metals are supposed to fall. When inflation runs hot and monetary policy stays tight, gold and silver are supposed to struggle. That's what every finance professor will tell you. That's what every Wall Street analyst has in their models. And yet, here we are watching silver rally nearly 4% in a single session while Fed officials talk about keeping rates at 3.5% to 3.75% for the foreseeable future. Something has changed. Something fundamental has shifted in how these markets work. And if you don't understand what that shift is, you're going to keep being surprised by price action that doesn't match your expectations. Today, I'm going to break down exactly what's happening, why the old rules no longer apply, and what this means for where silver goes next. Before we dive in, I want to know where you're watching from right now. Drop your country in the comments. Drop your city if you're comfortable. I've been watching the comments on these videos, and this community has grown to include people from literally every continent. We've got viewers from Singapore, from London, from Lagos, from Toronto, from Sydney, from Mumbai, from Sao Paulo. This is a truly global conversation, and your perspective matters because silver is a global market with different dynamics in different regions. So let me know where you're tuning in from, and let's see how far this community reaches. Also, quick request. If you're watching this and you're not subscribed, please take 2 seconds and hit that subscribe button right now. I know it seems like a small thing, but it genuinely matters. When you subscribe, you're helping the algorithm understand that this content is valuable. And when more people see these videos, more people understand what's really happening instead of just absorbing the mainstream narrative that keeps getting it wrong. So subscribe and let's keep building this together. All right, let's get into what actually happened this week because the headlines don't capture the full picture. 3 regional Federal Reserve presidents delivered hawkish commentary that should have crushed precious metals. Chicago Fed's Austin Goolsbee threw cold water on rate cuts, saying, quote, "We stopped making progress on inflation last year," end quote. He pointed out that inflation is running at 3% while the Fed's target is 2% and said that is not good enough. That's about as direct as Fed officials get. Boston Fed President Susan Collins said it will be appropriate to hold in the current range for some time. Richmond Fed President Tom Barkin agreed that rates at 3.5% to 3.75% are, quote, well-positioned, end quote. Neither of these officials are voting members of the Federal Open Market Committee this year, but their views reflect broader sentiment within the Fed. The market response was immediate. The CME FedWatch tool, which tracks interest rate expectations based on derivatives trading, shifted expectations for the first rate cut from June to July. The last time traders didn't expect a June rate cut was back in late July of last year. That was just before the chaos of August 1st when the jobs report shocked everyone and tariffs escalated dramatically. Now here's where it gets really interesting. When rate cut expectations shifted back in July of last year, gold was trading almost $2,000 per ounce below where it is today. Let that sink in. The same hawkish Fed stance that coincided with gold at around $3,200 is now coinciding with gold at $5,200. Same Fed, same policy stance, 60% higher gold price. What changed? Everything else changed. The world changed. And that's what I need you to understand. Gold touched $5,200 per ounce this week. That's a level that was an all-time high only 6 weeks ago. Now it's almost routine. Silver pushed back above $90, touching a 3-week high. Yes, silver is still trading more than 25% below the record highs from late January. But context matters. Silver hitting $90 while the Fed turns hawkish is not bearish price action. It's incredibly bullish price action. The metal is fighting through headwinds that should be pushing it lower. Let me ask you a question. When you hear that the Fed is delaying rate cuts, what's your instinct? Do you think silver should fall? Do you think it should rally? Do you think it shouldn't matter? Drop your honest answer in the comments because I want to understand how this community interprets these signals. Now let's talk about why the old playbook is broken. For decades, the relationship between interest rates and precious metals was straightforward. Higher rates meant higher opportunity cost for holding non-yielding assets like gold and silver. Lower rates meant that opportunity cost decreased, making metals more attractive. This inverse correlation was so reliable that traders would position based on Fed commentary alone. But look at the data. Across 2025, the price of gold in US dollars moved in the same direction as the odds of Fed rate cuts 60% of the time on a 5-session basis. That's a meaningful correlation, but here's the kicker. That correlation has collapsed to 35% of the time so far in 2026. The relationship that everyone assumed was fundamental to precious metals pricing has broken down. Why? Because there are forces acting on gold and silver that are now more powerful than interest rate differentials. Let me walk you through what those forces are. First, tariff uncertainty. President Trump delivered a record-long State of the Union address this week. Despite the Supreme Court's ruling that overturned the emergency tariffs imposed last year, the administration is keeping those tariffs in place under alternative legal statutes. The president said, quote, "Despite last Friday's disappointing ruling, these powerful country-saving tariffs will remain in place under fully approved and tested alternative legal statutes," end quote. What does this mean for investors? It means tariff chaos is not going away. It means the uncertainty that's been hanging over global trade for over a year continues. It means businesses and investors have to plan for a world where import costs remain elevated and trade relationships remain contentious. Mary Lovely, a senior fellow at the Peterson Institute for International Economics, put it bluntly, quote, "We're not going to see tariff relief in the longer run, and businesses know that," end quote. When businesses know that tariffs are permanent, they adjust their pricing, their supply chains, and their inflation expectations accordingly. That adjustment supports precious metals. Second, inflation persistence. The Fed's target is 2% inflation. Actual inflation is running at 3%. That gap matters enormously. At 3% inflation, your purchasing power declines by about 25% over a decade. At 2%, that decline is closer to 18%. The difference compounds over time and erodes wealth. When Fed officials say 3% is not good enough, they're acknowledging that monetary policy hasn't achieved its goal, but they're also signaling that rates are staying higher to fight that inflation. This creates a strange dynamic where the Fed's failure to control inflation actually supports the metals that protect against inflation. Think about it. If the Fed had successfully brought inflation to 2%, the case for precious metals as inflation hedges would weaken. But because inflation remains sticky at 3%, the protection that gold and silver offer remains valuable regardless of what rates do. Third, geopolitical risk premium. We've talked about this extensively on this channel, but it bears repeating. The world is not becoming less uncertain. Trade tensions persist. Regional conflicts continue. Nuclear negotiations create periodic scares. Currency volatility affects emerging markets. Each of these factors creates demand for assets that exist outside the control of any single government or central bank. Gold and silver fulfill that role. They can't be sanctioned. They can't be printed. They can't be frozen in accounts. For investors worried about geopolitical tail risks, precious metals offer insurance that no other asset class provides. That insurance premium is now permanently embedded in prices in a way it wasn't 5 or 10 years ago. Fourth, de-dollarization trends. Central banks around the world have been accumulating gold at record rates. This isn't speculation. This is documented by the World Gold Council and other official sources. Countries are diversifying their reserves away from dollar-denominated assets and toward gold. Why? Because the weaponization of the dollar through sanctions has made countries nervous about relying too heavily on the U.S. financial system. If your reserves can be frozen with an executive order, they're not really your reserves. Gold sitting in your own vaults can't be confiscated by a foreign power. This structural shift in central bank behavior creates persistent demand that doesn't care about Fed policy. Central banks aren't buying gold because they think the Fed will cut rates. They're buying gold because they're hedging against systemic risks in the global monetary order. Now, let me share something that I think perfectly captures the current moment in silver. I was reading an interview with Nate Miller, Vice President of Product Development at Amplify ETFs, and he made an observation that stuck with me. He said, quote, "Silver may not be the first metal to leave the station during a rally, but it's the fastest to arrive," end quote. That encapsulates silver's personality perfectly. Silver tends to lag gold in the early stages of precious metals rallies. It consolidates. It frustrates. It makes people question whether the thesis is still intact. And then suddenly it catches fire and delivers returns that dwarf what gold delivered. We saw this in January when silver spiked to all-time highs. The move was violent and fast, and then it corrected. We're now more than 25% below those record highs. The consolidation has been painful for those who bought the top. But here's what Miller said about investor behavior that I found fascinating. When asked if retail investors are panicking during this consolidation, he said, quote, "From the phones, we're not hearing it," end quote. Retail investors who understand silver's character aren't running for the exits. They're recognizing this as normal silver behavior. The metal that went parabolic is now catching its breath before the next move. Miller noted that during the sharp drop last month, Amplify actually saw buyers step in during the first leg lower in prices. That's not panic selling. That's opportunistic accumulation. The $70 range has produced more two-way trading activity, but overall, flows remain positive year to date. Money is still coming in. We saw this in January when silver spiked to all-time highs. The move was violent and fast, and then it corrected. We're now more than 25% below those record highs. The consolidation has been painful for those who bought the top. But here's what Miller said about investor behavior that I found fascinating. When asked if retail investors are panicking during this consolidation, he said, quote, "From the phones, we're not hearing it," end quote. Retail investors who understand silver's character aren't running for the exits. They're recognizing this as normal silver behavior. The metal that went parabolic is now catching its breath before the next move. Miller noted that during the sharp drop last month, Amplify actually saw buyers step in during the first leg lower in prices. That's not panic selling. That's opportunistic accumulation. The $70 range has produced more two-way trading activity, but overall flows remain positive year to date. Money is still coming in. Here's another insight from Miller that I think is crucial. He believes the market may be establishing a new floor rather than preparing for another immediate surge. Quote, "It does feel like there's probably a new floor, call it the $70 to $80 range, and we're in a consolidation period," end quote. Think about what that means. If the new floor is $70 to $80, that's massively higher than where silver traded for most of the past decade. We spent years watching silver languish in the 20s. Now the floor might be 70 or 80. That's a complete repricing of the asset. And Miller isn't bearish despite calling for consolidation. He said, quote, "There's probably another leg higher at some point," end quote. The open interest in the options market remains skewed toward calls, meaning investors are positioning their portfolios for another upside breakout. The smart money isn't betting on collapse. It's betting on continuation after a breather. Let me pause here and ask you something. Have you noticed a change in how you think about silver prices? A few years ago, if someone said silver would be $90, that would have seemed insane. Now we're treating $90 as a consolidation level. Has your mental anchor shifted? Let me know in the comments because I'm curious how this community's psychology has evolved. Now let's talk about what comes next because that's what really matters for your decision making. The near-term outlook depends heavily on the Federal Reserve, but perhaps not in the way you'd expect. New leadership transitions at the Fed create uncertainty about policy direction. While market expectations had earlier leaned toward a more dovish stance, Fed officials have recently signaled the possibility of keeping rates elevated or even hiking if economic data remains resilient. Miller expects a period of what he called policy hemming and hawing that could keep markets range-bound through the summer. If that's right, silver might trade sideways for the next several months, frustrating both bulls who want immediate gratification and bears who want vindication for their skepticism. But here's the key point. If another leg higher does materialize, Miller suggested it may come in the latter half of the year. That timeline actually makes sense when you think about the factors we've discussed. Tariff uncertainty will persist through the year as legal challenges work through the courts and businesses adjust to the new reality. Inflation will remain sticky as supply chain adjustments and trade frictions keep costs elevated. Geopolitical risks will ebb and flow but never disappear entirely, and central bank accumulation will continue as the structural shift away from dollar dependence plays out over years, not months. All of these factors point to a second half of the year where the conditions for another silver rally could align. Summer doldrums give way to autumn activity. Seasonal patterns and precious metals historically favor the latter part of the year, and by then the current consolidation will have created a base from which the next move can launch. Now I want to address something that I think is underappreciated: the relationship between gold and silver, and why gold's strength matters for silver's future. Gold at $5,200 is extraordinary. That's a level that seemed impossible just a couple of years ago. The fact that gold continues making all-time highs provides a tailwind for silver. When gold is in a bull market, silver eventually follows and often outperforms on a percentage basis. The gold to silver ratio remains elevated by historical standards. That means silver is cheap relative to gold. Historically, when this ratio is high and gold is rising, silver tends to catch up aggressively. The January spike was an example of that catch-up trade beginning. The current consolidation is a pause, not an end. If gold continues climbing towards 6,000 or beyond, the magnetic pull on silver becomes stronger. Investors who feel priced out of gold start looking at silver as the more accessible play. The ratio compression trade becomes more attractive, and the money that hasn't yet moved into silver starts flowing. Let me give you some numbers to think about. Gold has rallied from around $3,000 in early 2025 to $5,200 today. That's a 73% gain. Silver rallied from around $30 to its January highs around $120. That's a 300% gain. Silver massively outperformed gold on the way up. Now silver has corrected to $90 while gold has held its gains. The ratio has expanded again. This is setting up the exact conditions that preceded silver's initial outperformance. If history rhymes, silver will eventually compress that ratio again with explosive upside. Quick question: do you own both gold and silver or just one? And why did you make that choice? Drop your answer in the comments. I'm curious about the asset allocation decisions people are making. All right, let me talk about the structural supply story because it underpins everything else we've discussed. Silver has what Miller called two-pronged support. On one side, there's a structural supply shortage tied to industrial use. Solar panels, electronics, electric vehicles, medical devices, and emerging technologies all require silver. That demand is growing while mine supply is constrained. This creates a deficit that has persisted for years and is expected to continue. On the other side, there's safe haven and de-dollarization demand on the investment side. Investors want physical silver as insurance against monetary and geopolitical risks. This demand competes with industrial demand for the same limited supply. When both prongs of demand are active simultaneously, as they are now, the pressure on available supply intensifies. Price has to rise to ration that supply. And because silver mine supply can't respond quickly to higher prices, the rationing has to happen through price rather than through increased production. This is why the floor has risen. The new normal for silver isn't $25 or $30. It's $70 to $80 according to those watching flows closely. The structural deficit has permanently repriced the asset. Now let me address something that comes up in comments frequently: the volatility. Silver's volatility can be brutal. The 25% decline from January highs was painful for anyone who bought near the top. These swings test conviction and cause many investors to abandon positions at exactly the wrong time. But here's how to think about volatility. It's the price of admission to an asset that can deliver 300% gains. You can't have the upside without accepting the downside. Silver doesn't offer smooth, linear returns like a bond. It offers explosive moves punctuated by terrifying corrections. That's its nature. The investors who succeed with silver are those who size positions appropriately and maintain conviction through drawdowns. They don't invest more than they can afford to see decline by 30% or more. They have time horizons measured in years, not weeks. And they understand that consolidation phases are normal and necessary parts of bull markets. If you panic sold during the recent correction, don't beat yourself up. Learn from it. The lesson is usually about position sizing. If a 30% decline causes you to panic, you were probably too heavily allocated. Adjust for next time. Let me share a framework that might help. Think about your silver allocation in two buckets. The first bucket is your core position that you hold regardless of price action. This is metal you're not selling for years. This bucket rides through all volatility without adjustment. The second bucket is your trading position if you choose to have one. This is capital you use to buy dips and potentially take profits on extreme spikes. This bucket requires more active management and accepts that you'll sometimes get timing wrong. Having clarity about which bucket you're operating in prevents the emotional confusion that leads to bad decisions. If you're selling your core position during a consolidation, you've confused the buckets. If you're holding your trading position through major peaks without taking any profits, you've also confused the buckets. Most successful precious metals investors I've observed have primarily core positions with small or no trading positions. The stress of trying to trade silver's volatility outweighs the benefit for most people. Buy, hold, ignore the noise, and check back in a few years. That's the simple strategy that works. Now let me talk about what I'm watching for signals going forward. First, the $70 level. If silver pulls back and tests 70, I want to see buyers step in aggressively. A strong defense of 70 would confirm the new floor thesis. A break below 70 would suggest the consolidation is deeper than expected and the floor might be lower. Second, the $92 level. That's the near-term resistance from February's highs. A clean break above 92 with volume would signal the consolidation is ending and the next leg is beginning. Failure at 92 multiple times would suggest more time is needed. Third, the $100 level. The psychological importance of triple-digit silver cannot be overstated. When silver first crossed 100 earlier this year, it generated massive attention. A sustained move above 100 would bring mainstream media coverage and new investor interest. That's when the melt-up potential becomes real. Fourth, the gold price. If gold continues making new highs towards 6,000 or beyond, it creates conditions for silver to catch up. Watch gold for clues about the overall precious metals environment. Fifth, Fed commentary. While the correlation has broken down, Fed policy still matters at the margin. Any shift toward acknowledging that rate cuts are coming would be a tailwind. Continued hawkishness isn't preventing rallies, but a dovish turn would accelerate them. Sixth, physical market premiums. We've talked about Shanghai premiums and COMEX inventory dynamics. If physical premiums stay elevated while paper prices consolidate, it confirms underlying demand strength. If premiums collapse, it suggests demand is weakening. These 6 signals give you a framework for interpreting incoming information. You don't need to watch every headline, you need to watch the signals that actually matter. Let me now address the macro picture because silver doesn't exist in isolation. The tariff situation President Trump outlined in his State of the Union creates an environment of persistent trade friction. Businesses are adjusting to a world where tariffs are permanent features rather than temporary negotiating tactics. That adjustment supports inflation, which supports precious metals. The Fed's admission that inflation at 3% is not good enough tells you they haven't won the inflation fight. They can talk tough about keeping rates elevated, but the reality is inflation remains above target despite aggressive tightening. This failure supports the inflation hedge case for gold and silver. The de-dollarization trend continues in the background. Every month brings news of bilateral trade agreements settled in non-dollar currencies. Every quarter brings data on central bank gold purchases. This structural shift doesn't move markets day to day, but it creates a persistent tailwind over years. Put all of this together, and you have an environment that should support precious metals, regardless of short-term Fed noise. The forces driving gold to all-time highs and silver to $90 are not going away. They're intensifying. Now, before I wrap up, I want to hear from you on something specific. What's your price target for silver by the end of this year? Are we going to see new all-time highs above 120? Are we going to stay range-bound between 70 and 100? Or do you think we actually go lower? Drop your prediction in the comments. I'm building a record of community expectations that we can revisit later. Also, for those who've been in silver for a while, I'm curious about your journey. When did you first buy? What was the price? How has your conviction evolved through the ups and downs? Share your story in the comments because these personal experiences help others who are newer to the space understand what this ride actually feels like. Let me leave you with one final thought that ties everything together. The fact that silver is rallying while the Fed turns hawkish tells you something profound about where we are in this cycle. The old rules have broken. The textbook relationships no longer hold. Precious metals are trading based on factors that transcend interest rate differentials. This is what a paradigm shift looks like in real time. It's confusing. It contradicts what you were taught. It makes you question whether you're missing something, but sometimes the market is simply telling you that the world has changed and your mental models need to update. The world that produced the old rules, a world of relative stability, manageable debt levels, cooperative international trade, and trusted institutions, that world is giving way to something different. A world of tariff wars, weaponized currencies, unsustainable debt trajectories, and institutional distrust. In that new world, the assets that offer independence from those systems become more valuable, regardless of what the Fed funds rate is. That's the real story here. Not whether June or July gets a rate cut, but whether the entire framework for understanding precious metals needs to be rebuilt from first principles. I think it does. And I think gold at 5,200 and silver at 90, despite hawkish Fed commentary, is evidence that the market agrees. Thank you for watching. Subscribe if you haven't already. Drop your comments with your location, your predictions, and your silver journey. Like this video if you found it valuable because it genuinely helps more people see this content. And I'll see you in the next one. Stay patient, stay informed, and stay positioned for what's coming.